All right, we'll go ahead and get started. Good afternoon. Thank you for joining our quarterly webinar. I'm Lucy Barbarian. I'm joined today by our investment team members. They're going to take you through a review of the quarter. We will take a Q&A at the end, so feel free to take or send questions in throughout. And I'll hand it off to our CIO, John Regan. He'll jump right in.
Hi, everybody. We're going to cover performance first up, and then we will do a quick review of the markets and what's hot, what's not. This quarter and this year, moving on to the performance, four things I always look at every morning. The S&P has gained about 15%, while gold has gained about 47 or 50%. Treasury yields are down. Treasury yields are down since the beginning of the year. They're down about 60, 70 points to about 4.2%. We think, the Fed and the Treasury still wants to kind of jawbone those rates lower. And oil is a loser. Oil is now in the 50s. We've got overproduction, surplus overseas, and Saudi has not stepped in to lose share. So that's the one declining commodity. Interestingly, if you look at the Goldman Sachs Commodity Index, with gold and silver and palladium and everything up and away, the index is actually up double digits for the year. And the reason is because it's very energy heavy. I would say actually the Goldman commodity index is less a commodity index than it is an energy index. So it's not a good balanced representation of commodities. Next slide, Luce. What drives the market? Well, what drives the market is off of the Monday morning lows in March with Lutnick's tariff slide, where we hit a down 1,200 point day. We are now up 34%. And, we'd sort of forgotten that we said originally at the beginning of the year, tariffs drive the market. Everything's been going straight up. And, we all kind of forgot about the tariff war. And you're up about 34% if you bought that day. But next slide shows that on Friday, when China trade war, the market cares about China trade war. And when the tariff was announced on Friday, that we were going to basically effectively embargo Chinese goods with a 100% tariff, we lost 3% on the S&P. So I think we found the one nerve that this bull market still responds to, and that is China tariffs. So we have had a delayed, postponed resolution here. And, I think in general, the Chinese are just trying to wait us out. They're going to continue to negotiate point by point, and it's continued to be trench warfare. But every time Trump says there's going to be 100% tariffs, you can expect a pretty big down day. The Mag 7 is a split bunch. We've got three stocks of the Mag 7, Tesla, Apple, and Amazon, putting up not great returns, and four stocks putting up better than S&P returns. If the S&P is up about 15%, NVIDIA is obviously driving a weighted return for the Mag 7 of up 17, but you're getting, dispersion. And I hate that jargon term, but you're getting a spread of numbers in this group. The US dollar is a loser. It is down 10% for the year. And this is the year-to-date performance of all the currencies. You can see, against the Dixie, which is the dollar index, I guess a basket of currencies, we're down about 10%. The other currencies, Japan and EU, have gained, I guess, 6 to 8% against us. The biggest currency move is obviously gold. We consider gold to be a currency. So the big move is, what else can you put your money in besides dollar? The guy said I wasn't allowed to play the Goldfinger theme, although I wanted to play it in the background of the whole presentation today. We have been big buyers of gold. And then mid-quarter, or probably earlier last quarter, we noticed the silver ratio. Silver is usually not something I pay enough attention. I don't consider ourselves commodity traders, but the silver ratio got so out of whack to gold. We had a great piece of internal research done by Xander Keogh, and he noticed that the ratio had reached an all-time high since the Hunt brothers. So we put a little silver position in alongside the gold, and silver has gained, I think, over the last, it really kind of caught up and surpassed gold. The silver return for the year is up 61, but the return in the quarter was, I think, close to 30%. So we had a 2.5% position alongside gold, using ETFs on the silver. Although our gold fund can physically buy in three different share classes: gold, silver, or palladium and platinum, and physically store it in the same warehouse, which is a cool little feature we built in. Crypto is behaving differently than gold. Crypto, when we had the big risk off test day last Friday, sold off. So when I think about gold, I get challenged by investors, okay, well, what makes gold go down? Well, something bad happens in the stock market, gold goes up. If something comes out of the Oval Office about tariffs, gold goes up. If people don't want to buy US treasuries because they hate us or they want to get out of the US dollar, gold is where the money goes. I try to think about, if we get inflation, gold goes up. I try to think about what will take down the precious metals train. And what I come up with was, at a certain point, the law of economics will take place. There's a certain cost to digging gold out of the ground. The cost $1,500 an ounce, $2,000. It used to cost about $800 an ounce a few years ago. I'm sure it's higher. But at $5,000, if you could forward sell gold, just like you drill oil, someone will start to dig holes. What we're a little more concerned about, and what we've seen with silver, is physical shortage of metal versus paper. And you saw the silver market is having issues in London. And they were trying to put silver ingots on planes and send them to London to fill the gap between the physical spot price and the futures price. And we think that you could get to a point where people come to the realization the gold market is a little more liquid than people think. Crypto, little different. Crypto has behaved differently in that it was really risk off for crypto on Friday. Even though crypto has been on a longer term chart, this year has not been as good as gold and silver, but crypto has been a place where money has gone, instead of US Treasuries. Big interesting headline during the quarter is the Chinification. So we made that word up. For those of you who are dyslexic out there, we like to put words together and make new words. So the Chinification of US industry, which is when the US government steps in and creates winners and losers. And Intel was obviously identified as a strategic asset and got a little help from Trump with a 10% stake as the fee, and Intel was maybe saved from almost certain death. We think this is going to happen in the defense industry. We think it's going to happen in the chips industry. We think it's going to happen in rare earths. There's going to be a closer alignment of U.S. investment via the DoD, the Department of Energy, and Treasury with winners and losers. And it's we're no longer in the free markets and kind of laissez-faire economics. And I think that we're doing this to really compete with China, which has run their economy like that. AI spending is off the charts. There's a whole lot of money being invested. I think a lot of people are saying it's hitting bubble levels. I'll restrain my judgment. I don't know, but it does remind me of kind of the 90s, late 90s, when dark fiber was being laid and there were no demands for it. It's just if you build the dark fiber for the internet, it'll be worth something someday. And there were companies that went out of business. There was a company once called Wiltel that bought a bunch of dark fiber, and our business partner Joe Steinberg bought a bunch of that dark fiber out of bankruptcy and made a lot of money on it later on. So I think that a lot of money will be made in AI. The only thing is the seats may change hands before the money's made, but there's a tremendous amount of investment going into this right now, which is driving electricity demand. So the safer play might be to look at U.S. power demand and look at how we're going to satisfy that. That is why you're seeing a run in uranium stocks. Right now, everyone apparently is going to have a nuclear reactor in the back of their car and in their garage. And that's why the uranium stocks are going north, and as well as any other supply for uranium and power. Ivy League liquidity, switching gears a little bit to one of my favorite topics. Kind of the chickens came home to roost this year with PE. and getting in a bit of a squeeze between the government and fines and the over allocations. Um, if you look at this chart, you say, wow, well, Harvard and Yale just are completely over allocated to P, but relative to the size of their endowments, their unfundeds are around 8 billion of, north of 40 and $50 billion of investments. Um, Interestingly, Cornell, kind of where I spent time with the endowment is not anywhere near as funded. We kind of learned our lesson back in 2008. The attempted secondary sales of the PE never materialized. We did not really see many trades, probably mostly because they didn't like the prices. If you're going to try to sell secondary PE, we had heard the discounts were as high as 20%. The government shutdown, appears to not phase U.S. equity markets, and it just looks kind of silly at this point. We also think that what the GOP is doing, or what the Trump administration is doing, is using it as an opportunity to lay more people off, which will not help the jobs numbers, which have not been great. So on the what's hot, what's not summary, what is hot, we'll go through the hot list first. All metals, gold, silver, platinum, uranium. Our favorite uranium stocks up about 80% for the year, and that's Cameco. AI stocks have kind of gone to the moon. International equities are ahead of U.S. equities, so unhedged, especially unhedged Europe and Japan, have gotten the currency benefit of an extra 7 to 9%. U.S. growth stocks are doing better than value stocks. Tariffs are a hot issue. They will move markets. So if we have more China tariffs, you can expect to see volatility. High yield spreads are very tight. Interestingly, high yield spreads are very tight, and the high yield and investment grade spreads are very tight. But we are seeing some colossal train wrecks in the private credit market, where we're seeing cracks in credit of heavily levered companies. The one that kind of came to mind, other than what you've seen in the headlines over the last couple of days, is BDO Seidman, an accounting firm, had gone to Apollo for financing for their ESOP plan and is now struggling with layoffs. And because they took a lot of private equity money at, think about a 9% interest. This is, the credit is starting to crack a little bit on more heavily levered companies. Aerospace and defense, people have heard me say that, if I was going to quit this job and just pick one sector for the next 10 years, $1 to $1.5 trillion of defense budget has to move to buy less F-35s and less carriers and more drones and missiles. And they're going to need new suppliers and completely different weapons. Public equities and hedge funds are having a great year, as opposed to private equity. And last, China and EM are the best performing sectors out there in the market. China is up, I think, in the mid 40s, and EM is in the high 20s. What's not hot? Credit. We're seeing cracks now. We're seeing cracks in the private credit market, and we should be aware of that. The U.S. currency is down about 10%. Private equity exits are stalled. We're not seeing a lot of exits. We're seeing a lot of funds being raised, but not a lot of exits. Oil just continues to slide, which is good for our economy. Job creation is not great. Jobs numbers are terrible. U.S.-China trade relations are not good. BDCs are also getting hit with some of the credit, with some of the credit problems as well. Healthcare seems to know no lows, and going into midterm elections, everyone likes to beat up on healthcare companies. So, beware kind of catching a falling knife there. Last, Argentina and France are in the definitely kind of in the stinky kid camp. Argentina has failed again. They are very worried about Milei losing the election, and Treasury has thrown them a lifeline because they do like the longer term reforms the guy's trying to put in. And France, obviously, I think, is on their fifth prime minister in 5 weeks. So those two. Well, France actually makes us a little concerned about kind of the EU in general, in terms of where they're going to get the leadership from. Let me hand it off now to Connor, who'll kind of get a little more into equities and a little more into some of the macroeconomic data.
Thanks, Sean. Thank you, everybody, for joining. John alluded to a bit of this, but I love this graphic on the left-hand side showing all of the deals going on in AI right now. So John mentioned CapEx spending, which is in a major way contributing to growth right now in the US. Why is this repeated in our presentation? Well, the thought process is if growth starts to slow, consumption starts to slow, but these AI companies are spending, that may be what buoys US markets and global markets. So we're kind of getting to a place, and we'll outline in this presentation where labor markets are heading, and where earnings could go. But in the face of all that, companies are still spending at an incredible rate. Slide 21. Interestingly, John mentioned China doing very well from an equity perspective. This chart actually caught me off guard. Xander put this in the deck. I would have thought as tariffs rolled out that China's net exports to the United States would have declined. That was true, but interestingly, the rest of the world's picked up that slack. So if you look at the black line, that's total goods exported. Blue is to the rest of the world, which is growing, and red is shrinking, which is us. So the question we'll probably soon get an answer to is, have tariffs negatively or positively contributed to China's economic growth? And right now it looks like they're having an opportunity to open up into new spaces. Slide 22, I feel like I've talked about this ever since I showed up at PermCap, and I'm sure it was talked about before me, is how expensive the US market is. As you've remembered, we've been historically overweight the US for a long time until recently. With where valuations are today in the United States, doesn't mean that there's not great stocks or that you should sell your US exposure, but we think that there's a ton of opportunity abroad, and we've expressed that in quarterly meetings with our clients. I thought I would show you some returns. We took our active managers that we use internationally. We have Europe, Japan, EM, EFA. EM is new, by the way, versus just the S&P. And what's really interesting is our 1, 3, and 5s are either bang in line or have outperformed, particularly our 3 and 1 versus the S&P. So our international managers right now are keeping pace or outperforming the United States equity market with a much lower valuation base. So if you look at the forward PEs on our portfolios internationally, you have the US at 25 times earnings, and then you look at like our EFA manager who's returned 20% this year, and their forward PE on their book is about 13 and change. So you'll actually notice in this quarter's books, we've reduced the US exposure more. We're down to about 50% allocated to US equities, which I think is the lowest weight ever in PermCap equity portfolios. For point of reference, the ACWI benchmark is in the mid 60s. On the bond side, a phenomenon that's happening that's impacting the day-to-day household is treasury yields are still rising. 30-year treasury yield, so long-dated treasuries. Why does that matter? Well, two things. In the blue shaded part behind this chart is Fed funds rate, so that's the anchor to the treasury curve. Those rates have been cut. We're about at 4% for an effective Fed funds rate, but the long end of the curve is still elevated. So that's important because it means mortgages are staying elevated, so you still can't borrow money cheaply to buy your home. And borrow rates, especially long-term borrow rates, are still very expensive. The United States obviously wants to see these rates come down to reduce our debt servicing cost. And just to put it in perspective of where yields are relative to the last 25 years, our 10-year yields are about 70 basis points higher over 25-year averages, and the 30-year yield is about the same, 80 basis points. So, but on the flip side, credit hasn't really seen the same kind of situation. Credit, investment grade and high yield has a massive bid still in the market, while returns have been somewhat maybe muted relative to the last few years we've seen. Spreads are still very tight relative to risk-free rates. So investment grade spreads are at 70 basis points above their risk-free government counterpart, and high yield spreads are at 2.7, well below 25-year averages. And we think part of that is people view corporate credit and corporate balance sheets as a stronger, safer bet than US Treasuries right now, which is kind of an interesting theory to ponder. Slide 27. We think companies are going to take advantage as rates come in to issue their next round of high yield debt. We talked about this coming out of COVID when rates were near zero. We're not at zero, but this would be quite healthy if companies can issue, you know, 3-4 year debt, 5-year debt in the high yield markets. We think that would actually shore up company balance sheets. The right-hand chart is what's more important, is to make sure that that issuance isn't out of whack relative to history. Despite tighter credit spreads, an elevated equity market, the job market seems to be puttering out a bit. We'll see how seasonal the last read was. We don't have September because of the government shutdown. But what's really interesting in slide 29 is despite a weakening labor market, which is in the blue shaded region, declining over the last few years, the S&P, which is in the dark blue line, has hit new highs. So we have kind of Wall Street continuing to be disconnected from Main Street, which is not a new theme. We highlighted the origination of OpenAI just as a data point. It's not correlated per se, but there is something to consider as it relates to AI increasing productivity in lieu of needing to hire more people. With that said, I'll pass it to Alex to talk about interesting things beyond just stocks and bonds.
Thanks, Connor. So I'm going to briefly touch on some of the assets we own outside of the realm of stocks and bonds. I know you've heard plenty from us about gold and silver, but it's worth spending just another minute on in lieu of these remarkable moves. Then I'll touch on some of the performance from our hedge fund and co-investment portfolio. We showed this chart back in our January webinar. Our conclusion at the time was gold was moving higher, but the retail investor had not been participating. That's changed. So since this red call out here, total ETF gold holdings have gone from 83 million troy ounces to 97.5 million today. And now that private investment flows have caught up to a lot of the central bank buying that drove the 2024 gold run, you now see banks like Goldman Sachs calling for $4,900 per ounce gold prices. So beyond geopolitical and economic uncertainty, we do think Fed cuts can further support the case to own gold here. The same chart here for silver, these dynamics can lead to even more amplified moves. So it looks similar, but the silver market is 9 times smaller than the gold market. And John alluded to, the reports of availability issues for physical delivery in London are driving a short squeeze with prices jumping 30% in the last 6 weeks alone. We purchased silver, next slide, Xander, for the first time in the firm's history back in April, thanks to Xander's work, who identified how stretched the gold to silver ratio was. That's the amount of silver needed to buy an ounce of gold. And over the last 75 years, this ratio has averaged at 62 ounces of silver. It hit a high of 105 back in April, right as we started purchasing, actually. I guess better lucky than smart. But today that ratio still sits around 80%. And, from our initial entry point, we're up about 60% since our initial investment.
And Alex, let's go back for a second to this silver chart. One more. So just a note here, what you own matters. How you own it also matters. And we elected about 13 or 14 years ago to go to the trouble of setting up our own physical storage. And this was at the behest of Joe Steinberg, who thought it might be kind of cool to own the bars as opposed to owning an ETF. And the commodities markets can get, the price of gold in China and the price of gold in London are 2 different prices, just like the price of oil, Kern River crude is very different than Saudi Arabian sweet. Gold may have the same periodic table purity in both places, but the supply will dictate the price, and that's called basis. We didn't want to be held hostage to basis risk. And so we opened an LP where we have over $100 million of client assets, where we very simply once a month buy or sell whatever we have for gold. So we don't trade gold during the month. It is just literally for storage. And our storage is actually cheaper than that of the ETF because we have a lot of assets in it now. And we have the ability also to own gold, silver, platinum, palladium in the largest industrial metals vault in Texas, in the US, audited. And we found this to be.
Can also be
go ahead, Alex.
Can also be redeemed for physical.
and you can redeem this in either physical or cash. So if you really want to have gold bars delivered to your doorstep, they can do it. We wouldn't recommend it, but you can do it. And the reason is we were a little suspicious as to the amount of paper metal that was out there versus the physical metal. And that's what you're seeing in London this week, where you're hearing about physical silver being moved from New York to London to fulfill deliveries on the exchange. These are very real shortages, and you can get very strange commodity prices. If you remember, negative $42 in WTI during COVID, because people were giving oil away because they couldn't store any more of it at the Cushing facility. So you can get into these super spike situations where there just isn't silver and someone is caught short and they're willing to pay whatever price. And that's kind of the situation we're in right now with silver. We haven't seen it yet in gold, but my theory is that people are going to find out the gold market is a little more liquid than they thought it was. Sorry, Alex.
Nope. Thanks, John. Now moving beyond precious metals, I'm going to touch on our hedge fund performance, which has been fantastic on both a year-to-date and trailing 12-month basis. For clients who want alternatives exposure, we offer the Alternatives Fund, which owns a handful of hedge fund allocations as well as select co-investment opportunities. Through September, our hedge fund portfolio was up 19.4%, outperforming both the S&P 500 and the NASDAQ. And even on a 12-month basis, we were up 22.5%, beating the S&P and just barely trailing the NASDAQ. And that's with, roughly 50% equity exposure. Our gains here have been broad-based. It's been special situations funds, some sector-focused, global macro. In our last two quarterly webinars, I highlighted Flat-Footed, who's an under-the-radar special situations fund, and Callaghan Partners, a long-biased healthcare firm. Both of those, Xander, just go back to the last chart real quick. Both of those are up 52 and 65% respectively this year, if you can see that column in the middle of the page. So pretty eye-popping numbers in some cases. Today, I want to highlight our third top performer this year, which is Discovery Capital Management. We've tracked Rob Citrone as kind of a top macro mind for a number of years now, and ultimately initiated a position in April of this year. In a very short 6 months, we're up 29%, outperforming the S&P by 900 basis points. And I'd even note that the fund was up another 6% through Friday, despite Trump's tariff-induced sell-off. But Rob invests globally, including some very esoteric locales like Argentina, Nigeria, and Turkey. But he's made money across equities, credits, and rate this year with just modest losses in currency. But his views, especially on equities and the dollar, have been integral into shaping our top-down view of the world this year. Here are some of our historical co-investment opportunities. These are all unique ideas we source from our network. They're public, private, equity, credit. We try to cast as wide a net as possible. I'd like to highlight one successful investment on the next page we're going to be wrapping up at the end of the year, and that's in reinsurance. We invested in a dislocated property and catastrophe reinsurance market back in 2023. This was following Hurricane Ian, which occurred in late October and created this massive supply-demand mismatch for reinsurance heading into policy renewals. And the thesis, which I'm sure many of us have felt in our insurance bills, was that the rates were going to increase anywhere from 25 to 50% on January 1st of 2023. And ultimately, that played out. Rates went up 40%. This dynamic even persisted into 2024, with rates continuing to rise. We actually added capital for 2024. We brought firm-wide exposure to this idea up to 25 million. And then heading into this year, the market remained hard, but we said, you know what, let's take some gains off the table and keep our principal in for another year. We've made 100% in the strategy. It has no stock or bond exposure. And what I'd say is the most surprising part this year is you had the California wildfires in January. Even still, it looks like this strategy, it's up 20% through September, barring any major events in October as we wrap up hurricane season. We think we'll end the year in the mid-20s from a gain perspective. So after 3 strong years, we're going to take our toys and go home and wrap this one up. But it's been a fantastic run for a pretty esoteric asset class for us. So with that, I think Lucy's got some questions we're going to open up for Q&A.
Thank you, Alex, and feel free to please send questions as we go. Alex, we can start with you following up on what you just touched on. How do you access the co-investments at PermCap, and do you have to be a client? Do you have to manage all of the client's assets?
No, we put together a vehicle back in 2020. It's a Series LP. Essentially, when we source an idea, we offer it up to our clients first, those we have, investment management agreements with, who get to enjoy the benefit of the co-investments at their base level management fee. But the vehicle does allow us to take in non-clients. The economics are different, but when we can, source capacity for an idea, or it can absorb additional capital beyond what our clients want, we will absolutely offer them to friends of the firm, prospects, other family offices, what have you.
Lucy, can you flip back to the co-investment page, please? Thanks. Our co-investments, what we do is we put together a share class within our co-investment fund, and each of these boxes represents anywhere from 2 to 25 million in individual co-investments into the manager, and we write one check. The reason we do it that way is so we can aggregate and kind of go to the manager, sometimes even get better fee structures for our clients. Our clients of the firm do not pay any additional fees whatsoever on these investments. They just get the benefit of being a client. So if you have 10 million here at the firm managed in any products, you don't pay any fees on these co-investments. If you're a non-client, but you do want to access this, you can do so through the Perm Partners Fund, and there will be a management fee and a performance fee on those things. So you can access it in smaller amounts, and we don't need to manage all your money to do it. So it's a very easy, clean way for us to serve our clients, get better deals for them, get them access, and not charge them additional fees.
Thank you. John, I think this question's for you. You've been less hawkish on China this call than in the past. Has anything changed?
I forget who was it that said, when the facts change, I reserve the right to change my opinion. I think that we are obviously a strategic competitor with China. I think that if detente breaks out, I think we're too important to each other's economies to wall off entirely from one another. I think that the move to less worse relations is a big move. And actually, I think we've had a big move in China already, like up 43% or so. So the move to less worse is always the biggest move. And the relations have gotten a bit less worse. I don't think we're buddy-buddy, but maybe the possibility of Taiwan invasion, which is good for no one, is a bit lower now. And so never say never. I think that if a long-term deal can be worked out for Taiwan, and everyone can claim victory and go home, and we get a 20-year or 10-year off-ramp to move some of those chips to Arizona or somewhere else, then you're in a lot less precarious situation. And then Xi gets to claim victory, Trump gets to claim victory, and the markets can just be stable.
Thank you. Outside of gold and hard assets, what has been PermCap's best portfolio call this year?
I can take that. I would caution to say that we're not a hedge fund. We're not making like daily investment calls. We think very long term. I think one of the stronger long-term decisions the investment team made was increasing our weight in Japan maybe 2 years ago. That and having exposure to exporters specifically in Japan has been a great investment for us. And I think that's on the back of my previous slide about great companies growing earnings at a much lower multiple abroad. And so that's been a great contributor performance in the portfolio up until recently in lieu of EM. EM obviously is working well this year. But I think the Japan and international equity allocation has been good.
To stay up at the asset class level, our clients own anywhere from 10 to 20% gold, depending on the risk tolerance for it. Everything is kind of tailored to everyone's own risks. That has been the biggest contributor at the portfolio level. We lowered bond weightings about 18 months ago. That was also a very big contributor to performance. So equity weights have been much higher over the last 2 years. That has had a much greater impact. This year, going to 55% US or 50% US and 50% international. International returns have been up anywhere from 20 to 30% outside in our equity book. So that has been a big impact. So these are the big asset class numbers. And those have been the biggest impacts on the portfolio. Within Perm Partners, the biggest impacts on the portfolio have been the co-investments, the gold, as well as the reinsurance, the Stone Ridge reinsurance investment.
Okay, we have two more questions. Have hedge funds turned a corner and started to generate alpha again?
I'm gonna be careful about what I say because it can be used against me. But there's a lot of data that shows long-short equity outperformance in rising rate environments, and we've seen that play out since 2022. I'll use a word that John said he doesn't like, but you are seeing stock dispersion. So I think our generalist and sector-focused long-short guys, for the first time in a while, have the opportunity to make money on both sides of their portfolio, long and short. And then there have been some eye-popping numbers on the macro side because I think there's no shortage of themes globally that have really had room to run beyond things like metals and commodities. But the currency moves have been large. So we're seeing success in that portfolio, really top to bottom, and I think it's going to persist.
Okay, and then our final question, what has been the firm's progress on including Bitcoin in client portfolios?
Take that.
Yeah, I think it's case by case. I think we're in the business of not forcing views onto clients' comfort levels, and clients all have different risk parameters. It appears, whether for good or for bad, Bitcoin is becoming a bit more institutionalized with, for example, the growth of IBIT, BlackRock's ETF. I think Bitcoin has a lot of volatility associated with it, and so allocating to it, I think it requires requires being prudent. But in certain cases, we've seen clients starting to ask to have it alongside their gold and silver as another hedge against currency debasement.
Thanks, Connor. I think John, you want... Oh, sorry.
Yeah, Bitcoin is definitely an asset class. Crypto is an asset class. I think where you are with it with clients are kind of where gold was 10 years ago. Gold could suck the air out of a room in an investment committee. And once you mentioned it, like people would just run to different sides of the room. And some people thought you were crazy to own it. The one thing I would say is that the crypto and Bitcoin look to be positively correlated with NASDAQ as opposed to negatively correlated. So it does look like kind of a levered play on, the same people, but just kind of on leverage. So I don't know if it gives you safety when the world is ending. So it doesn't have that characteristic of gold, but it's certainly an asset class. And as Connor said, we're agnostic. We're agnostic and we're flexible. If clients do not, if they believe it's hocus pocus and they don't want it in their portfolios, we don't put it in. And if clients believe it is an asset class and it's going to grow and it's got scarcity value, then we put it in. So that's where we are. And I kind of liken it to where people were with gold maybe a few years ago.
All right, that was our last question. John, then the next slide, if you want to talk about upcoming events.
Oh, yeah. Next week, we'll host our 5th speaker series. We have Steve Schenfeld, who is the founder and chairman of Mid-Ocean Credit Partners. He is an old friend, someone we've done business with for 10 years. He is also an expert in the credit markets. And so I think it's going to be great. He's got the tough act of following Bill Ackman and Scott Besson as our last couple of speakers, but he agreed to do it anyway. So that is at the Citadel next week on October 21st. And the start time will be 5:30. So if you're in town, please let us know. And then we're going to be repeating and doubling in size the Vine conference, which is our values-based investment network exchange. And that is 3 days for our faith-based clients. So faith-based investing, media, politics, sports, and art, and of course, Charleston barbecue. So that will be in April. Please let us know if you're interested in attending or if you know someone who would like to attend. So those are kind of the big upcoming events. We look forward to kind of wrapping up the year. It's been a really good investment year. I think that we have already started to try to take a little bit of risk off the table, even starting a week before the end of the quarter. And we're cognizant of kind of the excesses that, we're seeing in different parts of the markets. Thanks a lot for joining us. And we look forward to speaking to you in January.